Hi everyone, my name is Michael Finney, and the goal of this channel is to share the advice that I've gained over the years to help you grow and advance without having to make the same mistakes that I've made. Now with this video, I wanted to share the lessons that many successful individuals have shared with me on investing in the stock market. For beginners or those new to investing, this may seem daunting and very intimidating. So what I did here was compile the advice that I've gained over the years to create a simple checklist for guiding you when to start to invest in stocks. The checklist will help you understand the market conditions, identify quality stocks to purchase, and confirm the timing of when to pull the trigger to buy and then sell the stocks. So let's jump in with my 7-step checklist for investing. Step number 1, understanding the overall market structure. What this means is looking at a broad stock market index to understand the trend. So what is a broad stock market index? Well, for example, here are 4 market indexes: the Dow Jones Industrial Average, the S&P 500, the NASDAQ, which is mostly technology companies like Microsoft, Apple, Cisco, and Intel, or for the Russell 3000 index. Now, when you look at, say, the S&P 500, the index can be in one of 3 structures, either an uptrend, a downtrend, or flat, which is referred to as trading in a range. The flat structure, or trading in a range, means that there will be an ebb and flow kind of consolidating between 2 price ranges, not breaking out just yet to the high or the downside. One simple way to determine the overall market structure is to check the 200-day moving average. Now, what exactly is the 200-day moving average? That is a calculation where you add the price of an index for each of the last 200 days and then divide that sum by 200 for the number of days, and hence the name 200-day moving average. Now, you don't have to worry about calculating the 200-day moving average on your own, as most websites like TradingView will easily give you the 200-day moving average. So let's use the S&P 500 chart to look at a few examples of market structure utilizing this TradingView website. So here is a view of the S&P 500 over the last 5 years. You can see starting in mid-2015 all the way to about November 2016, the S&P 500 was in what type of market structure? Very good. You guessed correctly that it was trading in a range, or was flat. We can see the 200-day moving average is kind of going through the index, meaning slightly above, then slightly dipping below, with a few more crosses over the index price. Next, we can see from about November 2016 to all the way to September 2018, the S&P 500 was in a uptrend. There was a break in market structure, and then the uptrend continued from January 2019 to February 2020. Here you can see the index is above the 200-day moving average, and conversely, we can see 2 downtrends, one lasting for approximately 3 months from mid-September to December 2018, and another downtrend from February 2020 to March 2020. And one final note, downtrends are always steeper than uptrends. So think about downtrends as taking the elevator and uptrends as taking the stairs. The next step deals with finding the right stocks to buy. Now you can deleverage your risk and buy exchange-traded funds, also known as ETFs for short, and there are index funds as well as mutual funds. With all these options, you are basically buying a basket or a collection of stocks. Say, for example, you could buy a S&P 500 ETF or an index fund from like a Vanguard or Fidelity, and that is buying all 500 of the largest US companies. Hence the name S&P 500. So the goal is when you buy the fund, it closely tracks the index's returns, which is considered a gauge of the overall US stock market. However, if you want to buy individual stocks, here are the fundamentals that I look for. The stock is in a growing industry. They have a debt to equity ratio which is less than 1. Their return on equity is more than 20%. Earnings per share, or EPS, is also over 20%. It has growing sales, has positive analyst ratings, and has a history of strong quarterly earnings, or last, has a upcoming catalyst that should move the stock price higher. For example, if there's a positive clinical trial result that you are expecting when you're looking at a certain pharmaceutical or biotech company, this could be seen as a catalyst for moving the price higher. For screening stocks, you can use a website like finviz.com, that's finviz.com, to search for and examine the criteria I just previously listed. Now, in step 3, once you find a stock to buy that meets your criteria, you want to confirm the overall market structure is in an uptrend, and you want to look at the market sector for that particular stock. Now let's take a step back. You don't want to buy in a downtrending market because you'll be fighting against the trend. Professionals who know how to get in and out of stocks at the right time, they may be able to buy in a downtrending market, but I would not recommend it for beginners. Keep this saying in mind. A rising tide lifts all ships. So the saying, a rising tide lifts all ships, means if the overall market is moving up, chances are the stock that you select will also move up as well. Now, you've got your stock to buy. It's an uptrending market. Next is you want to check the sector of your stock. So for example, if you are looking to buy Apple, you want to check the technology sector to make sure that the tech sector is also in an uptrend like the overall market. Sometimes there can be sectors getting hit hard, so in a downtrend, even when the overall market is doing well in an uptrend. So to quickly recap, we reviewed the fundamentals of a stock, like their sales, revenue, outlook, and started to touch upon the technical analysis that needs to be performed before buying a stock. Think of it this way. A fundamental analysis will tell you which stocks to buy, and the technical analysis will tell you when to buy. So fundamental analysis tells you which stocks to buy, and technical analysis tells you when to buy. The next step, step 4, is determining an area of value. So what do I mean by this area of value? Stocks don't move up or down in a straight line like in a linear fashion. There are peaks and valleys as the market tries to determine the fair value of a stock. There are 2 ways that I like to find areas of value. The first relates to support and resistance. An area of support is a price where the stock is moving down but then stops. The buyers of a stock come in and support the certain price point where sellers have trouble pushing the stock price further down. On the flip side, an area of resistance is when the buyers are driving the stock price higher but get exhausted and sellers come in and apply resistance, pushing the stock lower. When you are in an uptrend and buying a stock, you want to look for areas of support. So for example, your stock has been moving higher and there might be a small pullback to a previous level of resistance. This previous level of resistance now becomes an area of support and could be a good time to buy in order to take advantage of the pullback in price. Now, in step 5, you are ready to invest your entire life savings into that selected stock. Just kidding, hold up. Before you buy, I always like to figure out where is my stop loss going to be. Now, for those new to trading or investing, a stop loss is a price where you sell the stock that you just bought if it goes down. Now, don't take offense or don't take it personally if you are wrong and the stock turns down instead of going straight up after you bought it. Your number one job is to preserve capital and live to invest another day. So, how do you know where to set your stop loss, or what price do you get out of the trade? At a basic level, you can set your stop loss right below the next area of support. If you set the stop loss right below, it increases your chances that you will not get stopped out if the stock price retests that level and then turns higher. So Warren Buffett has two rules. Number one, don't lose money. And number two, don't forget rule number one. In William O'Neill's book titled How to Make Money in Stocks, the key to being successful in the stock market is not to be right all the time, but to lose the least amount of money at all times. So as a rule, William O'Neill says to cut each loss at 7 or 8%. As a more advanced way to set your stop loss, you can use what is called the average true range. This is an indicator that is commonly available when researching stocks. So next, step 6 and last 7 are your entry and exit strategies. To figure out your entry price based on technical analysis, you want to wait for your uptrending stock with good fundamentals to have a slight pullback in price. There should be a period of time when the stock is in what is called a consolidation phase. There is usually lower relative volume and the price volatility is decreasing as the price trades into a tighter range. You want the chart to look like an ascending triangle with higher highs and lower lows. Then you know there is a greater probability that the stock is ready to break up higher. But on the other side, be cautious and careful if you see the opposite and the stock price is forming a descending triangle, which means the stock may break lower. The last step, once you see the right setup, but before you buy the stock, you want to think through your exit strategy. Don't think about where you want the stock to go, like I want to double my money and then I'll sell. Think about where the stock might see some resistance. As the stock moves up, you may want to think about scaling out to secure at least some profits. Let your remaining position in the stock ride until you see a break in structure. For example, as you are monitoring the stock and you see it dips below the 50-day moving average, you may want to use that as an indicator that the market structure has changed from an uptrend and the stock may continue back down. Look at the area of value. If the price is way above a trend line that you place on your chart, it may not be able to keep up that momentum and it'll probably come back down to earth. So, as a recap, here are the 7 steps. Number 1, what is the overall market structure? So for the S&P 500, what trend is it in? Is it in an uptrend, downtrend, or flat in a range? One way to check to see the price, if it's above the 200-day moving average, that can tell you the trend. Number 2, what are the fundamentals of a stock? Do profits, revenue have a history of increasing? And is the stock positioned in the industry for continued growth? Number 3, how is their market segment doing? If they are in technology, are other stocks doing well? Number 4, what is the area of value? Draw your support and resistance lines to figure that out. Number 5, what is my stop loss? The price where I should sell if the stock turns lower should always be known before you actually buy the stock. Number 6, what is my entry trigger? Is there price consolidation after a run-up, so a slight pullback is offering a good buying opportunity? And last, number 7, what is my exit strategy? When should I start to take profits and when should I sell the remaining shares? So if you like this video, do me a favor, click the subscribe button, give me a thumbs up, and remember, start today. You have nothing to lose, but everything to gain.